There's a moment right before every major market crash in history that almost nobody recognizes for what it is. The quietest warning sign. It isn't a headline. It isn't a panic. It isn't a flashing red indicator on a financial news broadcast. It's the opposite of all of that. It's the moment when everyone stops worrying, when the headlines stop warning, when the analysts stop predicting downturns, when the recession odds collapse, when the market hits a fresh all-time high, and everyone agrees the danger has passed. That's when crashes actually arrive. Not when fear is high, when fear is gone. And right now, in 2026, fear is quietly disappearing. A few weeks ago, recession probability on prediction markets was sitting at 37%. People were genuinely worried. The Iran conflict was hot. Oil was spiking. Headlines were screaming about stagflation. Then something shifted. The Iran tensions cooled. Oil pulled back. The market climbed. And those same recession odds collapsed to 17%. Wall Street exhaled. The narrative changed overnight. The same analysts who were warning about a downturn 3 weeks ago are now talking about the resilience of the American consumer and the durability of corporate earnings. The S&P 500 is hitting record highs as I record this. The optimism is back. The fear is gone. And historically, that is exactly the kind of moment that precedes every crash that nobody saw coming. Tonight, I'm going to walk you through what's actually happening underneath the surface of this market, the cracks Wall Street isn't talking about, the warnings the headlines aren't running, the reasons the next crash, whenever it arrives, will almost certainly catch the majority of people completely unprepared. Because the truth nobody wants to admit is simple. The crash nobody sees coming isn't the one in the headlines. It's the one Wall Street just stopped worrying about. And that's exactly when crashes happen. Before we go into specifics, you need to understand something about how crashes actually work, because almost everyone gets this wrong. The crash is never what you expect. The crashes that get predicted in the news rarely happen. The crashes that actually happen are almost never predicted. In 2008, everyone was worried about inflation and oil prices. Then the housing market, which most analysts had assured everyone was fine, collapsed and took the global financial system with it. In 2020, nobody had a pandemic crash on their bingo card in February. By March, the market had dropped 34%. In 2000, the dot-com bubble didn't burst because the world ran out of internet enthusiasm. It burst because a few overvalued tech companies started reporting bad earnings, and the entire narrative cracked overnight. In each case, the actual trigger wasn't the one being warned about. The crash came from a direction nobody was watching. This is the pattern. Crashes don't happen when the financial industry is afraid of something specific. They happen when the financial industry has convinced itself that the specific thing it was afraid of is no longer a problem. Right now, in 2026, the financial industry has just convinced itself that recession is off the table for this year. Oil concerns have eased. Earnings have held up. The labor market is still adding jobs. The market is at record highs. The headlines have moved on. The fear has been priced out. That's the warning sign. Not because a crash is guaranteed. Nothing in markets is guaranteed. But because every major crash in modern financial history happened during a period of exactly this kind of complacency. The fear leaves. The headlines turn green. And then, from a direction nobody was watching, the floor opens. When you understand this pattern, the current market doesn't look reassuring. It looks familiar. Let me show you the first crack underneath the surface of this market, the one that almost nobody is willing to discuss honestly, the AI bubble nobody wants to name. A huge percentage of the market's growth over the past 2 years has come from a small handful of companies tied to artificial intelligence infrastructure. Chip companies, cloud providers, AI software firms, the Magnificent Seven and their orbit. These companies are real. They generate real revenue. They produce real profits. But the valuations attached to them assume that the AI revolution will continue at its current pace indefinitely, with no slowdown, no competition collapse, and no demand correction. That's an enormous bet, and the entire market is now structurally dependent on that bet working out. Pension funds, retirement accounts, index funds. Almost every dollar invested in the broad market has significant exposure to a handful of AI-related companies because those companies have grown so large they dominate the indexes themselves. This is what J.P. Morgan researchers called concentration risk, and what one of their analysts described as a setup where sentiment reversals tend to be sharper and more violent. In plain English, if confidence in AI cracks even a little, the unwinding doesn't happen gradually. It happens all at once because everyone is positioned the same way, in the same names, with the same assumptions. The dot-com crash worked exactly like this. The internet revolution was real. The companies were real. The growth was real. But the valuations had drifted into fantasy, and when the narrative shifted, even slightly, the unwind took 2 years and erased trillions of dollars. The AI revolution may be just as real. The companies may be just as legitimate. The growth may be just as transformational. That doesn't mean the prices being paid for them are correct. It doesn't mean the concentration is safe. And it doesn't mean the market is prepared for what happens when the narrative shifts. This is the first crack, the biggest one, and it's the one Wall Street is most reluctant to discuss because so many of them are benefiting from the current setup. While Wall Street celebrates record highs, something quieter is happening on Main Street, and it's been happening for months. The consumer is already bending. Consumer credit card balances in the United States have crossed $1.3 trillion. That's a record. And the average household carrying credit card debt is paying interest rates above 20% on those balances. Defaults are quietly rising. Delinquencies are climbing. The percentage of Americans who can't cover a $400 emergency is still north of 40%. The amount of credit being used to cover basic expenses, food, gas, health care, has been climbing for 2 years. This isn't a consumer who's thriving. This is a consumer who's running out of room. Wall Street looks at consumer spending as a single number. They see that the number is still positive. They conclude that the consumer is fine, but the number is positive because the consumer is borrowing to keep spending, and borrowing has a limit. When that limit is reached, and it always is, consumer spending doesn't slowly decline. It collapses because the credit cards max out, the buy now, pay later schemes catch up, and the household is forced to cut back drastically all at once. This is how recessions actually start, not with a sudden event, with a quiet exhaustion of borrowing capacity that eventually shows up in the spending numbers all at once. And right now, in 2026, that exhaustion is being measured in real time. Consumer credit is at record highs. Default rates are rising. Small business confidence is at multi-year lows. The percentage of Americans who feel behind on their finances is climbing. The Wall Street narrative says the consumer is resilient. The actual data underneath the narrative says the consumer is one bad month away from breaking. When that break happens, the spending number will catch up, and by then it'll be too late for the market to prepare. There's another crack underneath the surface, and it's been there longer than anyone wants to admit. The housing warning. In the United States, the housing market has effectively frozen. Buyers can't afford the prices at current interest rates. Sellers don't want to give up their low-rate mortgages from the previous decade, so the market just stops. Sales volume has dropped significantly. New construction has slowed. The inventory of unsold homes is climbing. Foreclosure rates are rising. Mortgage application numbers are at multi-decade lows. This isn't a healthy housing market. This is a paralyzed one. And here's why that matters. Housing has historically been one of the largest drivers of consumer spending. People who feel wealthy because their homes are appreciating spend more. People who feel uncertain about their homes spend less. When housing stalls, and especially when foreclosures rise, the spending effect ripples through the entire economy. Furniture stores, home improvement, appliances, construction, real estate services. Everything connected to housing slows down at the same time. The housing sector, by most independent measures, has already entered its own quiet recession. The broader economy hasn't followed yet. But these gaps don't last forever. Eventually, the rest of the economy catches up to what the housing market has already been telling us for months. The financial industry doesn't want to talk about this loudly, because housing is too closely tied to consumer confidence, and consumer confidence is the foundation of the current market narrative. But the warning is sitting there, in plain view, for anyone willing to look at it. Let me show you something. Not a theory. A scene. Two investors on the same day, two friends, both in their 30s, both with retirement accounts, both with money invested in the market. It's a Tuesday in May, and the S&P 500 has just hit another record high. The first investor, let's call him Daniel, opens his investing app and feels good. His portfolio is up 19% this year. He's been thinking about buying a new car. The market keeps climbing. The economy seems fine. He sees the recession odds have dropped to 17%. He sees the headlines talking about resilience and durability and how the worst is behind us. He decides to put a little more money into the market this month. He moves some of his emergency fund into stocks because, frankly, it just feels like he's being too conservative. The cash is doing nothing while the market is producing big gains. He tells himself he's being smart, capitalizing on the bull market. The second investor, let's call her Priya, opens the same app. Her portfolio is up the same 19%. She could be doing the same things Daniel is doing, but she does something different. She looks at her account and sees not the gains, but the position. She sees how much of her portfolio is concentrated in a handful of AI-related companies through her index funds. She sees consumer credit balances at record highs in the news. She sees the housing market frozen. She sees the Fed about to cut rates in an economy that doesn't actually need cutting. She doesn't panic. She doesn't sell. She doesn't try to time anything. But she does something quiet that most people will never think to do during a record high. She rebuilds her emergency fund. She brings her cash position back up. She makes sure she has a year of expenses sitting in a high-yield savings account. She doesn't pull money out of the market, but she stops moving more in. She lets her existing investments keep running while she rebuilds her ground floor. She knows she can't predict when the crash will come, or whether it will come this year, or next year, or in 3 years. She knows that nobody can. But she also knows that when crashes do come, they come without warning. They come from a direction nobody is watching. And the people who survive them aren't the ones who predicted them. They're the ones who were positioned to absorb them. Two investors. Same Tuesday, same record high. Two completely different responses. One is preparing for the party to continue forever. The other is preparing for what happens when the music finally stops. Neither of them knows which one of them is right. But only one of them is going to be okay either way. Now we get to one of the cracks that almost nobody outside finance is talking about, and it could turn out to be the most important one of all. The Fed is about to make everything worse. The Federal Reserve is supposed to be politically independent. Their job is to manage interest rates to keep inflation stable and the economy healthy. Sometimes that means raising rates to cool things down. Sometimes that means cutting rates to stimulate growth. In 2026, the Federal Reserve has a new chair, Kevin Warsh, who is expected to cut rates aggressively this year. By most independent analyses, the economy doesn't actually need those cuts. The labor market is still adding jobs. GDP is still growing. Inflation is still elevated. So why are rate cuts coming? Political pressure. The administration wants lower rates. The new Fed chair was appointed knowing that's what's expected. And the rate cuts will happen, not because the economy is asking for them, but because the politics is. When the central bank cuts rates into an economy that doesn't need cutting, two things happen. First, inflation tends to come back. The lower rates stimulate borrowing, spending, and asset purchases. Prices rise. The Fed's hard-won progress on inflation can unwind quickly. Second, the market gets one final, artificial leg up. Lower rates push more money into stocks. Valuations stretch even further. The bubble, wherever it exists, inflates further before it finally bursts. This is the most dangerous combination in financial history. Rate cuts into a strong economy, stimulating an already stretched market, inflating a bubble that's already showing cracks. It almost always ends the same way. A short, intense rally, then a sharp, brutal correction, sometimes a full crash. The financial industry knows this. The economists know this, but the headlines won't say it clearly, because saying it clearly would mean naming the political pressure on the Fed, which is uncomfortable for everyone. So you have to read between the lines. The Fed is about to cut rates into an economy that doesn't need it. That tells you everything you need to know about what's coming. Whether the crash happens in 6 months or 18 months, this is one of the most reliable setups for one in the last 50 years. There's one more crack that almost nobody is discussing, and it might be the biggest of all when you measure it by impact. The public isn't positioned for this. Retirement accounts in the United States have never been more exposed to stock market risk. Target date funds, the default investment in most 401ks, have automatically increased their stock allocations as the market has climbed. Many investors approaching retirement are now holding portfolios that are 80 or 90% stocks at the worst possible age to be that aggressive. Younger investors, who were told that stocks always go up over the long run, have piled in with no real understanding of what a major crash actually feels like. They've never lived through a 50% drawdown. They've never watched their portfolio cut in half over 12 months. They don't know how their nervous systems will respond to that. The result, when the next crash comes, millions of investors will panic sell at exactly the wrong moment. Retirement savers approaching their 50s and 60s will be forced to crystallize huge losses they can't afford to take. Younger investors will discover they're not actually the long-term holders they thought they were. This is the human dimension of every crash. The mechanical losses are bad enough. The behavioral losses, panic selling at the bottom, swearing off investing forever, missing the recovery, are usually worse. And right now, the public is positioned worse for a crash than at any point in recent memory. Higher stock allocations, higher leverage, higher exposure to AI concentration, lower emergency fund balances, higher consumer credit balances. The system is full of investors who have only known a rising market, who have been told that dips are buying opportunities, who have been trained to stay the course without understanding what the course actually looks like during a real bear market. When the crash comes, whenever it comes, the carnage won't just be in the indexes. It'll be in the financial lives of millions of people who weren't ready for what staying invested actually requires. The crash nobody sees coming isn't just an event, it's a generation-defining test that most investors will fail. While the public stays heavily invested and Wall Street celebrates record highs, a different story is unfolding in the background, and almost nobody is reporting on it. What the wealthy are quietly doing now. The most sophisticated investors in the world, the ones who run institutional money, who manage family offices, who have decades of cycle experience, are not behaving the way the headlines suggest. They're trimming positions, they're raising cash, they're rebalancing aggressively toward defensive sectors, they're building hedges, they're shortening duration on their bonds, they're moving into hard assets and quality companies with durable cash flows. This doesn't make the news because it's not exciting. It's not a single dramatic call about a coming crash. It's just thousands of quiet, professional decisions to reduce risk while the public is increasing it. The wealthiest people on earth don't try to time crashes. They prepare for them, quietly, over months and years, by adjusting their positioning while the rest of the world isn't paying attention. They sell into strength. They buy into weakness. They build cash positions when markets are euphoric. They deploy cash when markets are terrified. This is the opposite of how the public behaves. The public buys when prices are high and confidence is everywhere. The public sells when prices are low and confidence has collapsed. The public's average return is always worse than the market's average return because of this single behavioral asymmetry. The wealthy don't outperform the market by being smarter. They outperform by behaving in the opposite direction of the crowd. And right now, the crowd is euphoric. So the wealthy are getting ready. You don't have to be a billionaire to follow this pattern. The behavior is what matters, not the scale. While the public adds risk into a record-high market, you can quietly reduce it. While the public chases the latest hot AI stock, you can quietly rebalance into boring, durable holdings. While the public empties their emergency funds to buy more stocks, you can quietly rebuild yours. The wealthy aren't doing anything magical. They're doing what the public refuses to do, preparing for the cycle when the cycle is least expected. Now let's get practical, because the point of this video isn't to make you afraid, it's to make you prepared. How to position for this right now. If a crash arrives in the next 12 to 24 months, and it might or it might not, the people who survive it well will share certain characteristics. None of these require predicting when the crash will come. All of them work, whether the crash comes next month, next year, or never. First, rebuild your emergency fund. If your cash position has shrunk over the past 2 years as the market climbed, build it back. 12 months of expenses in a high-yield savings account is the foundation of every crash-survivable financial life. The bigger the cash buffer, the less likely you are to be forced to sell stocks at the bottom during a crash. Second, audit your concentration. Look at what your index funds actually own. Many investors don't realize how much of their portfolio is concentrated in a handful of AI-tied mega-cap stocks. If you're uncomfortable with that concentration, you can rebalance into broader funds, international funds, or value-weighted funds that reduce single-name exposure. Third, stop adding leverage. Pay off high-interest debt. Don't take on new debt for anything that loses value. Don't margin your investments. Don't speculate with money you can't afford to lose. The investors who get destroyed in crashes are almost always the ones who were carrying leverage when the crash arrived. Fourth, keep contributing, but to investments, not speculation. Dollar cost averaging into broad index funds works in every market environment. You'll buy at high prices now. You'll buy at low prices later. Over decades, the math favors you. Stop trying to time. Just keep contributing. Fifth, prepare your psychology. The single biggest predictor of long-term investing success is whether you can sit through a crash without selling. Most people can't. They think they can until the moment comes. If you've never lived through a major bear market, decide now, before it happens, that you will not sell. That promise to yourself is worth more than any market prediction. These 5 moves don't require you to know when the crash will come. They protect you whether it comes or not. They're not bets, they're foundations. And foundations are what every crash separates from everything else. The investors with foundations survive. The investors without them don't. So let me leave you with this, the question you carry with you. The crash nobody sees coming is the one that nobody is preparing for. That's not a coincidence. That's the entire mechanism. Crashes don't arrive when fear is high. They arrive when fear has just left. They don't show up when warnings are everywhere. They show up when the warnings have been dismissed. They don't strike when investors are cautious. They strike when investors have just been convinced that caution is no longer necessary. Right now, in 2026, fear is leaving. Warnings are being dismissed. Caution is being labeled as missing the rally. The S&P 500 is at record highs. Recession odds have collapsed. The narrative has flipped from worry to optimism in a matter of weeks. This is not the calm after the storm. This is the calm that the storm uses for cover. The underlying cracks are still there. The AI concentration is still there. The consumer credit problem is still there. The housing freeze is still there. The political pressure on the Fed is still there. The over-leveraged retail investor is still there. None of those problems went away because the headlines stopped covering them. They went into the background, waiting. The crash that comes from this setup, whenever it comes, will be the crash that nobody saw coming. But everything you needed to see was already visible. It was just being ignored. So here's the question I want you to carry with you for the rest of the day, the one that matters more than anything I've said tonight. If a major crash arrived in the next 24 months, would your current financial life survive it? Not survive it perfectly, not survive it without pain, just survive it. Would you still have your emergency fund? Would your portfolio still be there in some form when the recovery began? Would you have the cash to keep investing through the bottom instead of having to sell at it? Would your debt load allow you to hold on, or would it force you out at the worst possible moment? If the answer to those questions is uncertain, if you're not sure whether your current setup could survive a real bear market, then now is the moment to fix it. Not after the crash, not when the headlines turn red. Now, while the market is calm, while the headlines are green, while everyone else is celebrating record highs. Because the people who survive crashes are always the ones who prepared during the calm before them, never during the panic of them. Most people won't prepare. They'll keep adding risk. They'll keep believing the recession was canceled. They'll keep telling themselves that the headlines are right and the cracks aren't there. And then, one Tuesday morning, the floor will open, and they'll discover, too late, that the calmest moment in the market was actually the most dangerous one. The crash nobody sees coming is already on its way. You don't have to be one of the people who didn't see it. You only have to look at what's actually there, and quietly, calmly, do something about it, before the rest of the world finally catches up to what's been visible the whole time.